So the project that they put onto the FASB's table relates to financial statements for nonprofits. So they're looking at changing the way your financial statements look right now. Their main goal was to make them more relatable to the user of a financial statement. So if somebody is coming in, who are the main users of our financial statements? We have to file with the Attorney General in a lot of states. If we have debt, the debt holders, whether it's a bank or an underwriter, is a user, or the donor. Right? Those are the main users of our financial statements outside of the organization themselves. So they're looking at how do we improve that? Looking at the net asset classification and deciding that's complicated. People don't understand those three classes. They look at unrestricted net assets and think that means, oh, that's money that you can spend on anything, right? It's available. What do the restrictions mean? What does temp restricted mean? What does perm restricted mean? And then liquidity. How can we get liquidity information out of the financial statements? If I read the footnotes, how do I know how much cash this entity actually has available to spend? So that was kind of the crux of the project that they started, and let's see if they accomplished their goals by what they've come out with. The first thing we're going to walk through is net assets. As everybody knows right now, the current presentation is the three categories: unrestricted, temp, and perm. Now you guys, how many of you have temp restricted or perm restricted? There's quite a few of you out here. So this will impact you. So their proposal, after going through many iterations of saying, let's maybe categorize some as restricted for capital, restricted for debt requirements, is their proposal will contain 2 categories. So we're going to go from 3 to 2. Without donor restrictions and with donor restrictions. So they're hoping that will be less confusing. I don't know that it solves the liquidity question, but again, those are the amounts, are the 2 categories. What they will do, though, is the restrictions relating to perm and temp will still be there. They'll still be disclosed, so you'll still have the same amount of disclosures. It's just on the statement of financial position and the statement of changes in net assets. Instead of having the 3 categories, you'll have 2. Since 2009, they came down to 2. So the pros of this, they say it's easier, it's not as complex, but again, you still have to track it internally. So it's still as complex for you, but it's easier for the reader to understand. The cons, again, there's less transparency on the face of the financial statements. How many people actually read the footnotes? Most people, oh, Nat reads the footnotes. Thank you, Nat, I appreciate that. I read the footnotes, but that's my job. Again, there's less transparency as to what's could be available into the future, i.e. temp restricted, versus what's in your endowment. There's a disconnect between your internal tracking, your financial statements, and again, it doesn't address liquidity concerns. It's still not giving the reader of the financial statement an understanding of saying, what is available, which net assets are available to be spent. It's just relating to donor restrictions, so they didn't broaden that prospect. They looked at going to the GASB. Has anybody ever looked at a GASB financial statement? GASB has many categories, and they break out net assets between if the board has appropriated funds. They're required distinctions. If it's restricted by capital, things like that. They looked at going into that and decided it was too confusing and went to this route. I'm not a fan, if you can tell. Liquidity is the next thing that they look to tackle. And from a liquidity, the things that they came up with was how to present liquidity on the financial statement. So if a reader would understand how liquid your assets are, is they're requiring a classified balance sheet going forward. Now, most organizations do have a classified balance sheet, so it's not going to be a major change. Right now, healthcare is the only industry that requires it. So it's now going to be required. You're no longer going to be allowed to have the unclassified balance sheet. You're going to be required to break out assets limited as to use. Now, this is a term, again, they're pulling from other industries. So this is a term that's pulled from healthcare, where healthcare has a lot of entities have bond funds that are restricted. So, restricted for, my bond principal payment, interest payment. If you have a HUD project, restricted for regulatory purposes, tenant deposits. Those will now need to be broken out separately on your financial statement, on your balance sheet. Separate out of operating cash, separate out of other investments.
Cathy, can you explain what a classified statement of net position is?
Oh, a classified statement, sorry about that. I just assume everybody knows accounting. A classified statement, a balance sheet means you have current assets and and you're breaking out assets between current and long-term, liabilities between current and long-term. An unclassified balance sheet is where you have to display your assets and liabilities in order of liquidity. So on the balance sheet side, cash is always first, and so to speak, and on the other side, your most current liability is first, accounts payable. But in a classified, it's just you group all your current assets together to show against your current liabilities. So again, note disclosures, you would have to now have required note disclosures on external restrictions. So if there's donor restrictions, we talked about that with the net assets. If there are restrictions on some of those amounts, they need to be disclosed. If you have contractual restrictions, those need to be disclosed. So again, that gets back to the assets limited as to use. If there's debt funds that are required to be held separately, or if the board has designated amounts to be set aside, that needs to be disclosed. Right now, some of these disclosures, especially the board, are optional. Some of the other things that they're looking for to get into liquidity, and by putting in the footnotes, is saying that you now need to define the time, what you use to manage liquidity. So how far out do you manage liquidity for your organization? Is it 30 days, 60 days, 90 days? You need to disclose that fact. You need to have some quantitative disclosures relating to what are your total financial assets, what is the amount available, not available due to limitations, again, getting back to the previous one, where are the restrictions? And then what total financial liabilities do you have due within that time frame? So if you say we manage liquidity on a 90-day basis, you now have to disclose what liabilities you have due within the next 90 days. So currently, if you step back and think about it, in our current disclosures, we have accounts payable, which can be due anywhere. Current liabilities are due within the next 12 months. So your current debt is the amount due within the next 12 months. You're now going to have to add the extra disclosure of what amount are you going to have due in the next 90 days? And when do most nonprofits issue their financial statements? Is it within 30 days, 60 days, 90 days after year end? We've argued back to the FASB saying that this disclosure is going to be stale by the time it gets into the hand of the users that you feel need to have this information. Now, granted, it does give you some liquidity, qualitative information, the information on how you manage liquidity for the short term. I can fully support qualitative information. When you have to start putting numbers together, it doesn't make sense in my mind. It's just adding a burden onto the preparers of the financial statements, and I don't know that it's giving the benefit to the users that they need, at least in a timely manner. So again, if this does pull through, we do suggest that if you don't already have a liquidity policy in place, that you adopt one. You review your current policy to determine if you need to make any implementation changes. So if you are currently going too far out and you decide we need to go at a shorter period of time to be consistent with our peers. And then periodically review that. Again, using your ERM conversation earlier, does something change? Is something going on that we need to address current economic factors?